and CEO at IDFC FIRST Bank, and joins in to talk about a pretty stellar Q4, what the outlook is when it comes to the loan growth momentum and whether or not they can sustain their margins. Thank you so much for taking time out and joining in. Let's hear it out then from the management, speaking with Nikunj.
Yes, indeed, Nikunj. I remember that walk the talk, so to say, show with you. And there were certain things we discussed there. I'm happy to say every one of them is playing to the plan. It's actually not about a blowout or a fantastic quarter. If you think the trend over the last 3 years, that's really very important. The trend line is so strong, which actually augurs well for the coming year. One of the key things to watch out, of course, we had a fantastic profit, like 2,400 crores of profit after tax this year. This is great. We feel good about that. But more importantly, something important is that the loan book grew by 24%, but operating profit grew by 67%. So really, what does that tell you? It tells you about good operating leverage kicking in.
So is the IDFC Bank now entering what could be called as a strong phase of loan growth, and the drag from the wholesale business, which in a sense had haunted us in the past, that is behind the bank?
More than a strong phase, I would say a steady phase of growth, because we believe that about a 23-25% growth rate we should sustain for a long time. Last year also was 24%. And considering that, most banks, I'd say, are posting about 20% growth rate in retail, 24 for us, coming from a lower base, should be reasonably possible. But, more proud than a phase of growth, I'd say is that we are really very proud about the asset quality. And, it shows in the gross NPA, net NPA, all that.
Currently, there is a fight for liabilities. And despite this fight for liabilities, big banks are trying to gather more deposits. Your deposits have grown 37% year on year, 9% quarter on quarter. Very impressive number. Will it sustain? Will you be able to generate this kind of liability?
Actually, that has been, you're right, that has been our, let me say, our most defining strength over the last 2 years. Our bank is really very good in getting deposits. There are branches, there are networks. Customer products are quite customer friendly. We focus really a lot on customer service. Like, we go crazy about it, and we put a lot of systems and controls and tracking and monitoring and feedback loops and correcting our systems. So we put a lot of effort in customer service. Brand has come really well, by the way, Nikunj. People think of a brand as a good, clean bank. So all of these things play a role in deposits. We feel these are sustainable factors with the service of brand. Next year, last year actually deposits have grown by something like about 44%, even if you took out the one-off income, one-off deposits of 2,000 crores we got during the end of this year. So this year again, 40 to 45% growth you should expect from us, and I think we'll do it.
So what you're guiding for is the 40 to 45% growth for FY24. But what about FY25? Do you think this growth, what you have now registered, it will not be a multi-quarter phenomenon? It could be a multi-year phenomenon?
Yes, it could be a multi-year phenomenon, because if you see last 4 years also at a stretch, our CAGR growth and deposits is something like retail is upward of 70%, which I'm now talking of 40%. I'm talking of slowing down, but still it's good, like 40%. Yeah, even 25, 26. We feel that banks will be very strong in deposits. But frankly, deposits are not that difficult as it's made out to be, because one is, of course, we're an early stage bank. Secondly, if you need more deposits, you just need to put up some more branches, go to new territories that we are not present in today, or open more locations, and you're in. So you should expect it from us that we do stronger deposits every year.
Your cost to income ratio, historical factors, have in a sense been a bit of an issue. Now that operating leverage has kicked in, do you see a marked improvement on that, and do you also see a marked improvement going forward in terms of your ROE now?
You see, last 4 years, cost to income has come down from 95% down to the 80s and mid 70s. Now we're down to 72. So it's pretty clear how that is headed, and you should expect it to come down from here in a steady manner. There are 2 reasons which is easy for you to understand why it will come down. A credit card business is currently loss making. It is posting, the cost is more than income. But by 25, we expect that to reverse. We expect credit card business to be firmly in profits and costs and income to be more than costs. So that is one big swing, and other is of course the legacy liabilities that's going to reprice. It should come down.
One of your biggest naysayers has been Morgan Stanley, and I was reading a report that Morgan Stanley also has changed their view on the bank. Does it feel good that now finally there are no naysayers left and everybody has a buy on IDFC Bank as a stock?
No. First of all, it's good to have a few naysayers. It keeps us grounded also, and makes us, come back with greater charge to achieve something. But having said that, yes, frankly, I always felt that Morgan Stanley never understood a business because they were just taking a ROE and putting on the grid and coming out of the valuation. They always called a stock of 34 rupees stock or 20 rupees stock, etc. But now that they've come back to 70, means one of the biggest, so to say, bears or analysts who didn't believe in us have come back with a positive glow on us. Yeah, it feels good. Actually, we were very confident of the business model. We were very confident. We were sure if we do our job, it will show. And I'm thankful they changed their minds.
So how will FY24 be different from FY23?
As the bank begins to now grow, what happens is that we will have two engines that will begin to fire now. And in 24, we expect that phenomenon play out. What we mean is that, if you see most large banks, including the big ones that we know, they have a large base of deposits and customer assets, etc. So existing base also gives them business. New business also gives them business. For us, because we're a new bank, we did not have existing base. We only had to hit runs from the new customers. So going forward, we expect that existing base will also give us deposits. We expect, of course, new to bank. So I think it will get better for us because of this phenomenon.
So as we look into the future, in terms of technology, in terms of adaptation, are you working on something which could, in a sense, give you an edge or a lead over others?
See, on the technology front, I think we are making every effort to be, let me say, cutting edge. And more important than cutting edge, we are trying to be in sync with the new ecosystem. For example, in bureau, we have plugged into the number of bureaus, so we get a full profile view of the customer. There is the new technologies of AI ML that are coming in underwriting. We are using those capabilities. We have developed a really good data stack so that we can get a good customer view of the customer. So the entire stack of the infrastructure layer, the application layer, the middleware layer, the engineering layer, let me say the channels, the customer, the whole stack we are really building well. And I think we have some advantages, yeah.
So just to wrap it up with one final question, in the course of last 2 weeks, we've heard comments from other big banks also. Big banks are talking about moderation in credit growth, but what you're indicating to us is a completely different picture. What you are indicating to us is that the bank is firing full cylinders, and FY24 will be another year of high growth.
Yeah, I'd say moderate growth actually. No, I'm not, by the way, very different than others. If you see the whole banking system is talking of reasonable growth, you see like between 17-20% everybody's posting. We're talking of maybe 23-24. So I wouldn't say I won't take those credits the way you're saying it. But I'd say that on the deposit side, of course, we expect to be continue to be very strong. That is one. Two is that I'd say that all the work over the last 4 or 5 years from my predecessors' time in building the bank and time, all that will come to fruition. We must have lost 2 or 3 years because of some issues here or there on a few things, COVID and bad loans and all that. So, but I think that phase is behind. If you look next 5 years, you should be, let me say, pleasantly surprised. You'll forget the past.
And as of now, even though you're growing for IDFC FIRST Bank per se and for the sector per se, you don't think that there is an NPA ripple?
Look, we track one thing, and we are very particular about it, okay? And that is what is our collection percentage on our primary bucket. Now, our collection percentage, and we report it publicly, by the way. We report month on month, not quarter on quarter. We report month on month collection percentage. Now, we are collecting 99.5 to 99.6% consistently. If you collect 99.5, only 0.5% moves to 0 to 30 DPD. If we sustain this, we are determined to sustain this. Our net NPA numbers on retail is 0.55%. Our gross NPA in retail is 1.5%. So we are very clear that we will not want to leave asset quality as an issue. And of course, we have to be very watchful for that, but we will be.
Okay, so that was the conversation of Nikunj with Mr. Vaidyanathan. For now, the stock is holding up comfortably given the fact that the earnings were quite better than Wall Street expected. In fact, for the market as a whole, 18,200 seems to